Imagine a world where a single policy decision in one country can ripple across the globe, toppling currencies, crashing markets, and triggering recessions in nations thousands of miles away. You've heard about central banks, interest rates, and international trade, but what if everything you thought you knew about global money was only half the story? Today, we're diving into international monetary policy and how the invisible hands of finance have shaped history and continue to shape our future. To understand international monetary policy, we have to go back nearly a century. After World War I, economies were shattered. Germany was printing marks by the wheelbarrow, Britain was trying to recover its global empire, and the United States emerged as a creditor powerhouse. The world realized that money didn't just belong to nations, it flowed, it borrowed, it owed, and it punished. Key figures emerge. John Maynard Keynes, the brilliant British economist, warned that rigid currency systems could ignite global crises. Meanwhile, the United States, with its growing financial clout, started experimenting with what we now call monetary policy, controlling interest rates, managing inflation, and influencing exchange rates. By the 1944 Bretton Woods Conference, the world tried to codify these lessons. The US dollar was pegged to gold, and other currencies were pegged to the dollar. Institutions like the International Monetary Fund, IMF, and World Bank were created to stabilize economies. But this was only the beginning. There were rules, yes, but as history would show, rules don't stop money from creating chaos. Let's start at the origin. International monetary policy in its earliest form was about balance of payments and gold reserves. Countries needed to maintain trust in their currencies. Too much printing, and your money became worthless. Too little, and your economy stagnated. The gold standard acted as a global stabilizer, but even as late as the 1920s, we see cracks. The US raised interest rates to protect the dollar, triggering capital flight from Europe. Suddenly, policies in one nation became weapons of economic warfare. This was the first hint. International monetary policy was never neutral. It could be used intentionally or not to create winners and losers. After Bretton Woods, international monetary policy entered its golden era, or so it seemed. The 1950s and 1960s saw global growth unprecedented in history. Central banks coordinated to maintain stability. The IMF provided loans to struggling nations, and trade flourished. But even then, tension simmered. Countries with weaker economies often became dependent on stronger ones. Latin America, Africa, and Southeast Asia borrowed heavily, sometimes more than they could ever repay. These loans were supposed to stabilize economies, but they planted the seeds of future crises. The 1971 collapse of Bretton Woods was the turning point. President Nixon closed the gold window, freeing the dollar from its peg. Suddenly, currencies floated, and the old rules no longer applied. International monetary policy became experimental, volatile, and often unpredictable. The world entered a new era of floating exchange rates, speculative markets, and monetary brinkmanship. The breaking point came in waves. The 1980s debt crisis hit Latin America first. Countries like Mexico, Brazil, and Argentina had borrowed billions, relying on commodity exports and low interest rates. Then US interest rates skyrocketed. Suddenly, their debts became unpayable. International monetary policy, designed to stabilize, now triggered massive defaults. Fast forward to 1997, the Asian financial crisis. Thailand's baht collapsed, then Indonesia, South Korea, and Malaysia. Capital flew out at unprecedented speed. IMF loans arrived, but with conditions that deepened recessions, high interest rates, austerity, privatization. Here's the twist. The very institutions designed to protect the global economy often exacerbated crises. Policies made sense on paper, but in practice, they punished ordinary citizens while saving financial markets. International monetary policy was no longer neutral, it had become a tool of power. The fallout was human and economic. Inflation skyrocketed, unemployment soared, and political instability followed. Governments fell. Social unrest spread. In many cases, debt relief arrived too late, and countries struggled for decades to recover. Yet the lessons were never fully learned. The 2008 global financial crisis revealed the same patterns. US monetary policy, particularly the Fed's low interest rates and quantitative easing, had global consequences. Capital flowed into emerging markets, creating bubbles. When the US tightened rates, these markets suffered. International monetary policy, now highly technical and abstract, was still devastatingly personal for billions of people. Global institutions tried to adapt. The IMF and World Bank reformed lending conditions. Coordinated G7 and G20 policies attempted to stabilize currencies. Yet crises keep repeating. Why? Because human behavior, speculative capital flows, and political incentives rarely align with theoretical models. Some nations responded by creating currency pegs, sovereign wealth funds, or capital controls. Others simply embraced risk. The pattern repeats: crisis, fallout, patchwork fix, and eventual new crisis. History shows that international monetary policy isn't just economics. It's a reflection of human ambition, fear, and error. Today, international monetary policy is more powerful than ever. The US Federal Reserve, the European Central Bank, and China's People's Bank influence trillions of dollars daily. According to recent data, the Fed's balance sheet now exceeds $9 trillion, larger than the GDP of most countries. A policy tweak in Washington can cause currency swings in Africa, debt crises in Latin America, and stock market turbulence in Asia. Patterns repeat. Low interest rates encourage borrowing. High rates trigger defaults. Speculative capital moves in milliseconds. Trade imbalances persist. Emerging markets remain vulnerable. International monetary policy is still a game of dominoes, with global consequences for each piece that falls. So what can we learn? Global money is interlinked. No nation's monetary policy is isolated. Your interest rates affect the world. Institutions help, but don't prevent crises. IMF, World Bank, and central banks stabilize, but history shows they often make the human cost worse. Patterns repeat. Debt accumulation, speculative capital, and currency volatility are age-old problems that remain unsolved. The real question is this: as technology accelerates, as digital currencies rise, and as global debt reaches historic highs, can international monetary policy keep pace, or are we setting ourselves up for another historic collapse? One thing is certain: the dominoes are still standing, but for how long? If you want to understand the hidden forces shaping your money, your job, and your future, subscribe now. We uncover the secrets of global finance, history, and the policies that move billions of dollars, because knowing the rules of the game is the first step to mastering it.